Good day there, Wealth Press viewers. Welcome to this Monday, the last week of June for 2020. I'm here at the round table. We're starting off with just myself and Roger Scott. Others may join us as the session progresses. Roger, welcome.
Thank you, James, and I appreciate you having me. I'm always looking forward to these sessions. It's a great way to start and end the week.
Yeah, you bet. And Jeff Zaninieri joins us now. How are you doing, Jeff?
Hey, good morning, guys. Nice
Hey,
to
Jeff.
see you.
We're looking at a small lift in the major markets and a lift across all commodities, which to me is extremely suspicious and probably representative that the market has not yet expressed a sentiment or direction yet. The Dow is up, oil is up slightly, gold is up slightly, everything's up. What's going on, Jeff?
Not everything's up. Not everything's up. Some
No?
of the Nasdaq stocks, the leaders in the Nasdaqs are getting hit today. That's something that you should be paying attention to.
Oh, okay.
A lot
So
of the
I haven't-
stay-at-home stocks, the Amazon's down 1.5% right now. Facebook's getting whacked. So believe it or not, it's actually even more suspicious than you thought, James, because the stocks that have been the best performing stocks of 2020 are being sold out of this morning. Continuation from Friday selling.
Right. Okay. So I just happen to have my my watch list ordered in a very optimistic order today. So
I didn't mean
okay,
to interrupt
interesting.
you. It's something I'm really focused on this morning.
You bet. So then, are the sell-off in the stay-at-home stocks and the COVID-19 stocks, is that a result of the increasing fear that is happening as a result of, we've had basically 4 days in a row of more than 40,000 new infections in the US, and that makes it the most infectious week yet in COVID-19 for America. And is that the driving force in the market this week?
Well, if I may, just want to give you my perspective here. We got to step back a little bit. This week is a short week. We have Friday, markets are closed, and we have FOMC on Wednesday. So those two things, and Jeff will also tell you this, whenever you have a fragmented week, regardless of whether it's Monday, Wednesday, or Friday, whenever you have a short week, you're going to have very little institutional money coming into the market, and most of the trading actions retail and very random. Now, that's just the fact that Friday's off. When you add into the mix the fact that we have FOMC data this week on a Wednesday, and unemployment and jobless claims on Thursday, there's a really good chance, I'm going to make a very, very educated guess, that large hedge funds are on the sidelines waiting to see what the Fed is going to say, waiting for the data. So you have a double whammy in terms of randomness this week. And this is just very simple. You could look at the volume, it'll tell you everything. So I think we have to look through the analysis with that filter in mind, because that has a lot to do with what we're going to be seeing this week.
Okay. And Jeff, that's that you echo that sentiment?
Oh, 100%. It's been a chop shop. Last week was actually a heavy volume week because I think, like Roger said, a lot of the real guys, as we call them, a lot of the senior decision makers, they take this whole week off usually in the U.S. Fourth of July week is a junior trader week. Like the managing directors, the PMs, and all the big funds, most just take this week off. So this is like a nothing week. So I think we saw a lot of the volume last week on those people repositioning going into this shortened week. I want to point one thing out to build on what Roger was saying with the unemployment numbers, when I'm really, really closely paying attention to. Obviously, the Fed is always really important as well. But last month, or it was actually the beginning of this month, we had the biggest surprise in economic misdiagnosis history. All of the experts came in with a 19% U.S. unemployment rate, and the real number was actually 13.3% unemployment. That was the biggest update, and it was the top. It actually represented the top of the last move on that day. It created a buying capitulation on the upside. You can capitulate on the upside too. And so since then, we've seen the market drift a little bit lower. But the point that I'm making to you is these economists that are supposedly the smartest dudes on the planet, to some, They missed this number by 6%. They're flying in the absolute dark right now. So nobody knows what's going on, right? So this month they've recalibrated their prediction to say that it's going to be 12.4% on Thursday, the unemployment rate. Who knows? It could be 8. It could be 16. My point is that if they were so off last month, there's a high probability that they might be off again a lot on Thursday, which will lead to fireworks. So if I'm looking at a day that there might be some huge moves, an outsized move, it's going to be Thursday. It's also the last trading day before a 3-day weekend. So something to pay attention to.
And it's the last trading day of the second half, the second quarter of the year.
And if they're going to, and just to add to what both of you are saying, if that does happen, and I think Jeff and I think both of you guys are right on the ball, because there's very little volume on Friday, we're going to see a lot of movement because you're going to see some adjustments to big positions, and the fact that there's low liquidity volume, that causes volatility to just go haywire. That's a perfect recipe. So if there is going to be volatility, the best odds is definitely late Wednesday, Thursday, first half of the day, maybe even second half of the day, without a doubt.
Okay. So I'm hearing from you guys that this is really a week where the prevalent terms could be random and unpredictable, which tells me that it's just really a week to keep your fingers out of the flames because you might get burned. Yeah. And
Yes.
Is that what you guys are planning to do this week?
Well, what I'm planning on doing this week, quite honestly, is I want to see if momentum levels can sustain themselves, and if VIX can sustain themselves, and the volatility can sustain themselves. That's really what I'm seeing, because right now, technically, I don't know if you saw my morning video. Probably not. I did it only about 2 hours ago. But we are technically right now. If I was to put a chart of the NASDAQ 100, and if I was to put the price action and my 10-day RSI oscillator, we are seeing identical divergence. Identical. So literally, what we're seeing right now in the market is it's like going back in time to what happened in the market in February, late January, early February, before the market crashed. So that's what I'm really focused right now, and momentum levels are backing me up on that. Internals are backing me up on that. And also, we have a descending triangle that's been building on the S&P 500. It's been there for 2 weeks, and if it breaks, it's going to take us again below the 200-day line. So I think we are going to be more random, but I am looking for more. I'm looking for stops to get hit at the 200-day line. What we could be getting ourselves into is another February period if things continue this way, and if we see more. Could be a perfect storm next week. So what I'm really looking for is I'm looking to see, hopefully, that this week will reverse course, because if not, we could be setting up for exactly what happened in February once again within the next 10 trading sessions. So I'm kind of cautious right now and lowering exposure.
Right. I've noticed that the commitment of traders in gold for the week ended May 23rd, or rather June 23rd, has seen incremental increases in open interest on the long side versus the short side rather strongly. So up like 50% open interest in the contracts since 2-week period, which suggests to me that there is a lot of long interest on the institutional side for gold. And is that perhaps indicative of a sort of defensive posture on the part of the institutional segment broadly? I
think it's twofold. I think it's kind of the reason that I was looking at it, which is it's the perfect inflation manifestation of all of this money printing that's happening. So whether you're defensive because of that or not, I think the fact is that money is being debased, whether we like not, in the most coordinated fashion in the history of the world. And so that's why you're seeing money flow into some stocks too. That's why even on a day like today, when the real stocks, the ones that people are really betting on, the real companies are selling off, there's money flowing into other things because there's all this liquidity. There's all this capital. So you're going to constantly be having this constant pressure of money that needs to go somewhere. It needs to go somewhere. And the bond trade for me, which is the ultimate defensive trade, feels really, really long in the tooth. It's been over a 30-year bull market in bonds. You're getting nothing but risk for holding bonds. You're certainly not getting yield. So gold for me is defensive, but it's really the debasement of the currency play. Technically, I love what it's doing right now. It's consolidating near its highs. It made highs last week, and it's not doing it in an explosive fashion. I expect to see some sort of explosive move, and I'm going to buy into the explosive move. I'm a little bit hesitant in the sense that I want to see a convincing move above 1800. And that's counterintuitive to a lot of people, because a lot of people say, well, why would you pay more for gold? Well, the truth is that once you wash out all that resistance, you make a whole new, what's called a pathfinder. You make a new path to get real return on the upside. So as a kind of a momentum trader, that's something I'm looking for with gold personally.
Roger?
I agree with everything Jeff said, except for one thing. I like what I'm seeing with gold right now. I like the fact that we're congesting near the top, but the only difference in my analysis, and I'm also looking for a breakout above 1800. The only difference in my analysis is I don't want to see a wide range. I don't want to see wide volatility, because I've noticed that, especially in the last few years, when we start seeing that higher volatility level, it tends to be the end of a trend. So I prefer to see the same type of volatility. I think we're going to see, I think we're saying the same thing, except Jeff is interested in seeing a pickup in volatility. I'm actually interested in seeing higher price, but I'm interested in seeing volatility levels remain steady, because if they remain steady, in my opinion, and based on my testing, I've seen that price tends to not peak out or be due to a pullback at those levels. But again, I'm talking from a trading perspective, not a position. I'm not talking from holding 2-3 months. If you're talking about holding a quarter or two, then it doesn't make any difference. It won't make any difference whether volatility is high or not. But I've noticed when I'm seeing a run, a bull or a bear run, and volatility tends to stay at the same level, the ATR doesn't go up or down. And ATR, for those who don't know, ATR stands for average true range. That's just the volatility levels of the asset we're looking at. I tend to notice that price tends to continue moving in the same direction when volatility levels stay constant. And when they start expanding a lot, they will move up, obviously, because volatility is higher, but they tend to peak out in a shorter period of time. That's all. But we're saying exactly
can I have a little rebuttal on that?
Of course.
Not my problem with it, but like gold is its own unique instrument. Gold is unique. What you're saying is 100% true, specifically for sure with stocks, because stocks can steadily go higher at a higher clip. Gold has a tendency to do nothing or everything. So I want to be there for that everything move on the upside, but I don't want to sit in gold for 6 months and have it do 1%, because I'm not viewing it as a safety net for my assets. I'm still looking at it as kind of a momentum trade. So my view of it is that if it's going to do nothing for 6 months and just like consolidate near the top, I think there's so many more opportunities for my capital in the market, because I actually run towards volatility, because there's a lot of, I like those ranges. I like those moves. So for gold in particular, I want to see that fast money crowd come into it so I can get back into it.
And so, Jeff, when you say, you're looking for the momentum action in gold, are you looking at the futures? Are you looking at the big miners, the juniors? What is your preferred flavor of gold?
Well, I mean, right now I'm in none of them. I have been on the show, and I have been long GDX in the past few months. I have been long the GLD. For my subscribers, I only focus on ETFs. I don't trade futures. I don't trade spot. Personally, that's different. I have a little bit of Krugerrand just because I'm a little bit paranoid, but not a lot, nothing insane. And so that's, but I watch everything. So when I'm talking about 1800, I'm talking about the spot price of gold. I'm talking about spot price, not future. I'm talking about spot price it's XAU on Bloomberg, to be really specific. But again, when we saw in 2008, when the Fed came in and they just sprayed the earth with money. When Helicopter Ben introduced when he was the founding father of MMT, when that happened, you saw gold when it started to move, when it broke above that psychological level of 700, it added 50% lickety split. So that's the kind of move I'm looking for. I'm not looking to make 5% on gold. I think gold has a 25% to 50% move in it if you start to see that momentum come into it and a breakout. But I also think that it could be dead money for a long time. So there's a possibility and a probability of both. Unfortunately, there's one thing that a lot of portfolio managers and traders don't talk about, which is opportunity cost. And so if you're looking to generate outsized returns, as all of us are, I know that for a fact, there's a huge opportunity cost for sitting in dead money.
Sure.
Absolutely.
Sure. But so what are the catalysts that you guys see that will cause gold to make that monster move? And what kind of time frame? I mean, the worst thing you can do is try to predict the future, as we all know. I believe it was Yogi Berra who said, I like to predict the future, I just don't like to say when. And so the future is the gold's going higher. We can't say when necessarily, but what are the fundamental catalysts that we can keep an eye out for that might suggest that this gathering momentum in gold is going to cause that breakout?
That's a great question. Let me start off. Let me just go back just for one quick second and just mention something interesting that a lot of our viewers may be interested in knowing. You asked Jeff, what do you prefer, miners? You were asking him that question, and something very quickly popped in my head. For the recovery that we've seen since the market has bottomed out, gold shares have outperformed actual gold 4-1.
The miners,
thus far. Now, I don't know if that's going to happen going forward if gold continues moving, but just FYI, as of right now, the leverage is a lot more in the miners than in the actual underlying gold. That may change, that may adjust, but it is quite a lot more, right? As we've seen since February. So just wanted to kind of give you that information. I thought it was kind of relevant because you asked, so your readers at least can have a choice of looking at different assets. But I think when it comes to gold, and I think if we're going to be looking at the kind of move that Jeff is talking about, 25%, which is entirely possible, I think we may need to look at it at a time period. It's not going to happen overnight, obviously, but I think one of the biggest factors that we need to take a look at is the elections. Right? I mean, we got a major thing, and I don't want this to become political because, well, I just don't want, because we're going to take it into a whole other direction. But I will say this, and I think most people will agree that if there's a higher chance that the stock market will stay bullish if we have Republicans in the White House than we have Democrats in the White House, at least historically and statistically. So I think if we start seeing a higher chance of perception that Democrats will take office, I think we may see a natural decline or a softening in the stock market, which may cause that catalyst that we're talking about now, potentially. So that is something we could be looking at. That's one factor. And again, this is just, and even if my analysis is, if someone does not agree with my analysis, a change in leadership in the White House is a major catalyst, a potential change, regardless of which way we go. And number two, and I'm picking real obvious things here. I'm not going really deep here. The second biggest thing is obviously COVID-19. It's the pink elephant in the room. And are we going to have a vaccine? Are we going to have a cure? We're being told. I was watching 60 Minutes yesterday, and from last night's 60-minute episode to this morning, there's already a change of it's just wild. You know, it's wild. We are in the wild west here. So I think those two are the major factors that the world is watching.
Mm-hmm. And Jeff, what do you see as the bigger catalyst for gold at the timeline ahead?
So I'm thinking the same way Roger is. I mean, I'll expand a little bit on the election thing. So a big factor that I mentioned was the expansion of the dollar supply through debt, right? Through printing money by issuing debt. And so this is also nothing new under the sun. If you get this blue wave in November, you can expect stimulus on steroids. You could expect basic income to be introduced. You can expect at least doubling of what we've already spent since COVID-19 in terms of the debt. So that is the biggest catalyst. It's also a 50-50 ball. I know that Trump is losing by a lot in the polls, but it's also the end of June. It's a fluid game. A lot can happen. So it's kind of like forecasting a catalyst in a game where you're still in the first quarter or the second quarter. Regardless, we're going to get more spending because I feel like it's not like I feel, this is reality. The economic impact of COVID has been severe, and we're not getting a V-shaped recovery. Roger and I discussed this last Wednesday, and it was why we saw a 3% decline in the stock market last week. And you led off with it, James, this morning, the most cases. I'm a half full guy. I'm still looking at it like hospitalizations and deaths are not exploding to the upside. A lot of really smart people, smarter than me, say that lags by a few weeks. So we have to wait and see. Fingers crossed that that's not the case. But regardless, if gold stays technical like this, if we have that underpinning of printing money and spending, a thing you really need to watch is interest rates. That's the canary in the coal mine. If you see U.S. 10-year rates start to go towards zero, there will be a huge, that's a catalyst that would be like, boom, instant 10% in gold.
Oh, yeah. Oh,
50 basis point collapse.
like this.
Like this.
Like
and
this.
The stock market with that move would also fall apart.
Yes.
Led by the financials. So those are things I'm paying attention to.
Mhm.
I couldn't agree more with Jeff, by the way, and it would be very fast. And
Fast.
I just want to add another dimension to what you're saying. You guys remember, this will actually, I think this will quite validate a little bit of, just push more your argument even further. If you guys remember when we first had that crash in February, remember the reaction the U.S. dollar had versus the gold market? It was first one had the reaction and one was barely moving, and then it was a complete reversal of that. That was in a sense, it's a different catalyst, but it goes in line with what Jeff is talking about. Because look at what happened. At first, when the wave was hitting the world, before it hit USA, money was just flowing into that US dollar. But as soon as US got infected, the money just poured out of that US dollar and went right into the gold market, because the world sees gold as a global defense mechanism, not a US defense mechanism. So if going back to what Jeff is saying now, taking it to what Jeff said, if the Fed was to undermine the economy by making interest rates near zero, which is one of the reasons why they don't want to do it, is the U.S. would not be a dominant force of attracting capital anymore, and that would have a major instant impact on the gold market. It's just another reaction, but it's interesting because we kind of saw a little bit of that in the world versus U.S. versus the world in terms of defensiveness in February, and I think this is just another perspective of it. But I think based on that was very, very powerful and very telling, and I agree a lot with what Jeff is saying here.
Sure. So post 2009 crisis, the trade in gold, the defensive trade in gold, was usurped by a very successful campaign to convince the world that the U.S. dollar was in fact the safe haven, and gold was very much not going to serve the interests of protecting capital preservation strategies. And that resulted in gold crashing to 1,100 and all of the money flowing into the U.S. stock market. Now, in this iteration of crisis, we have interest rates at a sliver, a hair of yield, and the stock markets are beyond fully valued. They're just obese with capital and value. And so my question is, and this is one of the things that I'm really watching in gold, is I think that there is increasing pressure for that explosive moment building towards September, October, because the Fed is quickly running out of options in its ability to induce support for US dollar debt and US dollar assets because they have so overinflated everything. So, I mean, fair enough about for your opportunity costs on momentum trades in dead money, if it's still months away. As a fundamentalist, and I don't mean of the religious variety, the trade in gold to me is very attractive right now for the juniors and the mid tiers by virtue of the increases that we're starting to see in the majors, which historically the pattern always goes gold spikes, the majors get the lift, the mid tiers start to consolidate, and the juniors start to get financed. Those are sort of the steps in the process before that preceded actually that 50% move that we saw back in 2000 and was it 7, I believe, or 6?
Six, I believe.
Yeah.
I believe it was 6. Yeah.
And then gold topped out at 1920 in September of 2014 or 12. I can't remember now. But those things are all, they look like they're repeating themselves. And there doesn't seem to be that much optionality for the Fed and its allies to take hold of perception and guide it away from gold towards any other US dollar asset. So you say 50%, Jeff, is the upside. I'm a little bit more starry-eyed when it comes to gold. I think there's a good chance that the price could double from here, especially if the institutions break down of the 10-year treasury.
That's the starting kit, James. That's the starting case, the 50%er. I'm talking about like tangible, like I can make that money in 6 months type of trade action. I think gold will settle in, could easily double. I think 5,000 gold is not unreasonable within a normal amount of time.
Sure,
I mean, again, we went from 700 pre-Great Financial Crisis to 1,900 in a few years.
Yeah.
Whatever you want to say, where it pulled back from there, circumstances are different this time.
Yes.
This time, we've actually gotten into a situation where the majority of the world is in a negative rate environment. The only thing, when I'm explaining finance to people that are really new to finance, the first thing you have to explain to everyone is that it's a lot like school. Everything is graded on a curve. You don't have to be an absolute A+ student. You just have to be the best in the classroom. And we can live in an environment where capital still flies into the Amazons and the Microsofts of the world, because frankly, there's not a lot of trillion-dollar companies anywhere else on the planet. So if you look at capital, there's two types of capital. There's debt and there's equity. And people are going to be paying for equity and finding equity where they can, with size, with liquidity. We still have the most liquid, and this is something that kind of pisses me off a little bit, or at least it's like a lack of perspective with like the US being unseated as the economic superpower, is that by a margin of like 10x, we still have the most robust capital market in the world on the equity side. And that's a function of the companies being that good. That's a function of the companies having that large a revenue scale to their business. It's not just like always just funny money chasing these crazy companies that won't be around. These are companies that are making $50 billion, $20 billion a quarter. These are big companies, and there's not a lot of those. So we can live in this binary world where you have these humongous corporate beasts sucking capital out of the world into the US, and gold also being bid, because that whole in between of bonds yielding nothing and bonds being negative, and a lot of mediocre companies in the US that are mid-size and outside in the rest of the world with declining business opportunities, we can live in that binary scenario. And I just don't see a situation where the rest of the world could even come close to getting out of negative rates. Once you go in, it's almost impossible to get out. Right. And that's why when I'm looking at the US, there's always a tipping point. I don't know if you've read that Tipping Point book by Malcolm Gladwell, but there's a tipping point.
Excellent book.
It's a great book, right?
Excellent book.
There's no going back. And I think when we get this debt increase in the US and you go, all of a sudden you're at 26 trillion, next thing you know, you're at 40 trillion, you cannot finance that debt above a fraction of interest. You can't finance it. They're going to pin it down because they will not be able to support 150 basis points, 200 basis points to pay for that debt. It's going to be the reality. So having gold in your overall portfolio as an investor is a must at a certain percentage. based on your, we're not financial advisors here, but based on your timeline, on your age, as a protection thing, for sure.
Especially now, yes.
Yeah. But when I speak about gold, I'm talking about it from my trading portfolio. So when I'm talking about opportunity, those are two different things, being an investor and being a trader. And Roger talks and you talk about it. And I really want our listeners to really understand that. When I'm speaking about gold, and I have it as an investment long-term, I have it in my retirement accounts, I have Crew Grant, I have gold. But when I'm talking about gold from this perspective, I'm talking about it for a trade, because I'm looking at this market is rock and rolling, and there's opportunities. There's going to be opportunities over the next 24 months in stocks that we haven't seen in our lifetime.
Right. Wow. Well, a very heady discussion this morning, gentlemen. We've run out of time. I would like to thank you both for joining me today, and I'll look forward to speaking to you on Thursday, Roger and Jeff, in the near future, if not next Monday. Have a great trading week, gentlemen.